Welcome everyone to another of our weekly investment manager videos, and many thanks once again for tuning in. Chinese equity markets have been in free fall over the past week as the ruling Chinese Communist Party introduced new regulation on companies that offer private education tutoring. The question is now, is this a sign of more regulation and even nationalisation, or a fantastic buying opportunity? Well, to give us insight into this evolving situation, I'm delighted to be speaking with Charlie Bond, Fund Manager of the Invesco Global Emerging Markets Fund and member of the Henley-based Asian and Emerging Markets Equity Team. But first, as ever, before we get into the content, it would be fantastic if you haven't already to subscribe to the channel. It really does help and support us in delivering our weekly content from both a financial planning and an investment market perspective. So, on to the content. First off, Charlie, many thanks for your time today. The first question that I have is there big trouble in Little China?
Well, thanks very much for having me, Andrew. I suppose you were right to point out that equity markets have been very volatile recently. I think it's important to set the scene. The context is incredibly important when looking at Chinese stocks. And the context is that the Chinese government have been on a long period of trying to encourage innovation in the economy. They want national champions and they want big technology companies to be domestic. They don't want the likes of Google and Amazon being dominant in China. So the government has been, if you like, the driving force behind the growth of technology stocks in China. So that's the first thing that's the context. And so to our mind, new regulation is not something that is designed to destroy these companies. It's something designed to enhance consumer protections. And that's not necessarily a bad thing. It is a quandary how governments should regulate technology companies. It's something that Western governments struggle with. And there's lots of evidence over the years of the Chinese regulator stepping in when it doesn't feel comfortable with things. So we've seen, over the last decade, cases of regulation on online gambling, gaming, things like search results. So there's been increased regulation on medical results that your search provider can give you. So the regulator has been involved, and it's not something new. I'd say this had been out of the news a bit recently in the last couple of years, and it had come back into the news last year when Alibaba, more specifically Jack Ma, founder of Alibaba, made some ill-advised comments about the Chinese financial system, which led to the cancelling of the Ant Financial IPO. That seemed to precipitate increased regulatory scrutiny on a number of sectors. And the first company that went into that, or the first sector that went into that, was e-commerce. So Alibaba ended up paying a big fine because they had been forcing exclusivity on a number of their merchants, which is an anti-competitive behavior. So they were fined nearly $3 billion, which is obviously a huge number, but not that significant actually in terms of the financial impact on Alibaba. Mm-hmm. But it's led to a broadening of regulatory interference. So we're seeing increased scrutiny of delivery companies, for example. They're having to like in the West actually, pay social security benefits to their employees, give them holiday, things like that. There's been increased regulation on data privacy. So this is something we're seeing across sectors, and it's not necessarily undermining the future value of a lot of these businesses. We would argue, we would say it's putting in place some of the necessary regulation that is required to protect consumers. However, there was some regulation in the education sector which which has effectively destroyed an industry. So the context here is that governments see education, healthcare, and property as what you would call, basic goods. So as part of common prosperity, it's important that those are things that all people have access to. So In China, the practice was to give your children after school tutoring in order to enable them to get better results in their exams so that they could get into the best schools. After school tutoring was something that you paid for out of your own pocket. And so the companies that provided these services had a huge, huge market to address because all parents want the best for their children. So that, in a way, felt perfectly natural from a Western standpoint. But the government have come to the view that the financial burden on families had gotten too high, and it was effectively creating too much inequality in the system. And so there was a piece of regulation which effectively reduces the market size for after-school tutoring and puts in place restrictions on foreign ownership of some of these companies, effectively undermining the profit motive. And so we've seen huge declines in share prices for education stocks, 80 to 90% declines from the peak. So really a complete loss of capital. I think it's too early to say what the regulation will actually, how it will actually pan out. There are often situations where the government come out with regulation that is then revised. There might still be a place for these companies in children's education, and it remains to be seen how big that market opportunity is. But it's pretty obvious it's going to be smaller than people thought it was.
Yeah.
So it's been a very volatile period, and we would point out that we don't have any holdings in the education sector in the emerging markets fund. We don't actually have any holdings in healthcare or property either. So the three they're called the three mountains, or they're so-called three mountains. They're not a big exposure in the fund, and so it's not been a period of underperformance for the fund as these things have been blowing up. But it has been impacting other areas. So today there's news about gaming being potentially the next area in which the government look to increase regulation.
Do all of these events change your view of risk within Chinese equities?
Inevitably, events like this make people assess the regulatory environment, and investors don't like regulation. So, what is risk? If technology companies are being thoughtfully regulated, does that increase their risk to investors? Possibly not, because it might mean that these companies, which in the past might have acted with little interference from the regulator, are now talking to the regulator on a regular basis. So there might be better cooperation between state and private enterprise, which can reduce risk in some cases. I would say, though, that the Chinese equity market has a high, it's been on a great run, and it's had a high degree of retail participation. And to our mind, risk is the risk that you lose money. And so when you come from a starting point of having done very well, that risk is heightened. So it's not surprising that stocks have fallen. But how we're valuing the stocks hasn't changed. Although clearly some people in the market are using a higher discount rate than they were in the past. Maybe people have got complacent about the risks in China. We've had an underweight position in Chinese equities for as long as I can remember. That's actually been closing. We've been reducing that. So I don't think the risks have increased particularly. In the long run, I think we'll look back on these regulatory interventions and say this is part and parcel of making sure that technology companies are fully engaged with society and acting in a responsible way, and that's not necessarily a bad thing. The other point is that it probably increases barriers to entry for a number of these companies. If what you do is seen as sensitive by the government, then by definition it's hard to start a new business that does that. So it's not universally bad news, and we've been looking for opportunities really in this weakness.
Yeah. Looking at that and looking at the emerging market fund, the Invesco Emerging Market Fund itself, how's 2021 been, and how are you currently positioned? Bearing in mind this event, bearing in mind everything else that's going on in the world.
Yeah. So 2021 has been, as I mentioned, it's been a volatile year. The fund is roughly flat. I think we're up 1 or 2% year to date. The market is down 1 or 2% year to date. So a little bit of outperformance so far. The the main the main thing we had been doing coming into this year though was selling technology companies. So in the second half of 2020, we felt that quite a lot of the valuations had gotten quite high, and especially definitely in the beginning of 2021, we were reducing quite aggressively. So we've been rotating out of technology into some more defensive sectors and parts of the market that have been left behind, frankly. So we have increased our exposure to consumer staples, and we bought a couple of technology companies as well. But we've also been adding to recovery or reopening plays that are still yet to pan out. So Latin America has been an area we've been adding to. So it's been fortuitous in the sense that we did reduce our technology holdings, but I would also want to make the point that the reason these stocks are going down is because they had gone up as well before that. So if this sort of regulation had come out after a period of 3 years of share price underperformance, people might not be talking about it. It might not have caused damage to the share prices because valuations were lower. The reason this is causing damage is because valuations are high and because investors are expecting good news in the future. So to us, this reinforces that point about being contrarian and about investing in areas where expectations are already low, because bad news is effectively already baked into share prices. So it's not surprising that we're seeing big moves in some of these stocks.
Yeah, and I think as we discussed before the recording, the markets are a fascinating position at this moment in time, right across the board: developed market, emerging market, fixed income. It's just really, really important at this moment in time to understand, who is managing that mandate for you, and certainly, you guys at Invesco, you've been able to deliver, and you're continuing to deliver. So long may that continue. Charlie, many thanks for your time today. It's an absolute pleasure to catch up with you once again. You stay safe, and I'm sure we'll catch up soon.
Thank you very much, Andrew. Likewise.